SPY and SPX look identical in a chart. They rise together, fall together, and turn together. But one is a real ETF made of stocks, and the other isn't a tradable security at all. It's a calculation. And if you treat one like the other, you misread volatility, missize positions, misunderstand returns, and build incorrect hedges. Here's what we're going to break down: what SPX actually is and how it's constructed, how SPY mirrors that index and why the prices move differently, the mechanics that create tracking precision and the frictions that break it, and when each product, SPX or SPY, is the correct choice for your account. SPX is the S&P 500 index, a real-time number calculated from the weight movements of 500 large US companies. But SPX is not a financial instrument. SPX has no shares, it has no order book, no bid, no ask. SPX has no trading volume because it doesn't trade. If SPX doesn't trade, why does its chart move? Because the underlying companies move. SPX simply reports the weighted change in their market value. SPX uses float adjusted market capitalization weighting. Only shares available to the public count towards a company's weight. Insider holdings and restricted shares are excluded. Larger companies naturally exert more influence on index movement. A top weighted mega cap can move a few percent and shift the entire index. SPX also uses an index divisor, a dynamic scaling factor that converts the combined market value of all 500 companies into a manageable index number. For example, if the total market value of the index rises by 500 billion, that change is divided by the divisor to determine how many points SPX moves. To hold that exposure in a real account, you need the implementation. SPY is the SPDR S&P 500 ETF, and it functions as an entirely different instrument. SPY has real buying and selling. It has live bid and ask spreads, auction mechanics, market depth, and liquidity providers. It runs to creation and redemption cycles, it distributes dividends, and it charges fees. SPX trades in the thousands. SPY trades roughly 1/10 of SPX, because SPY is designed to represent 1/10 of the index's exposure per share. Does the scaling change the percentage move? No. If SPX rises 1%, SPY also rises by 1%. If SPX falls by 0.8%, SPY also falls by 0.8%. Its absolute price is irrelevant. The percentage movement is what matters. SPY tracks SPX tightly because of its creation and redemption mechanism. If SPY trades above fair value, authorized participants sell SPY and buy the underlying basket of the S&P 500 stocks. If SPY trades below fair value, they buy SPY and redeem shares for the underlying stocks. This arbitrage keeps SPY aligned with SPX within a fraction of a percent. Place SPX and SPY side by side during the same move. If SPX is 6,000 and rallies to 6,060, a 1% move, SPY will move from roughly 600 to about 606, also 1%. This is the alignment professionals focus on. Points don't matter, percentage does. If you understand this relationship, you understand most of how ETF pricing works. SPY holds the actual stocks, which means it receives dividends and distributes them to the shareholders. SPX does not. SPX reflects price only. If SPY yields roughly 1.3 to 1.7% annually, that is real cash paid to the shareholders, and it becomes part of the total return. Over the long periods, SPY's total returns exceeds SPX's price returns for one reason: dividends. Because SPY captures the cash distributions that SPX doesn't. SPY charges a 0.09% expense ratio. It's small, but it compounds over decades. SPX has no fee because it's an index, not a security. SPY's price return will be roughly the same, about 10%. SPY then distributes dividends of roughly 1.5%. That puts SPY's total return near 11.5% for the same period. SPX reflects only the price portion, the 10%. SPX prints smooth turning points. SPY prints wicks, spikes, and micro noise. Because SPX is synthetic, it reflects only the weighted price changes of its components. No orders, no spreads, no auction mechanics. SPY is real and absorbs every element of microstructure. SPY reflects live order flow, bid-ask spread, liquidity depth. SPX reflects none of this. It's a calculation, not a marketplace. If you draw support and resistance on SPX, but execute trades on SPY, you'll be wicked out more often. SPX is smooth by calculation. SPY is not as smooth because it trades through live auction mechanics. Professionals handle this correctly. They chart SPX for structure and they execute SPY with microstructure in mind. SPY's price must closely reflect the value of its underlying holdings. Two institutional metrics enforce this relationship. NAV, the net asset value. It's the end of day value of the ETF's underlying holdings, calculated once daily after the market closes. And IIV, the intraday indicative value. It's a frequently updated estimate of the ETF's real time underlying value during market hours. They buy or sell SPY and offset the position in the underlying stocks until the price realigns. This is why SPY never drifts far from the index. SPY sometimes trades at small premiums or discounts relative to its underlying holdings. This can occur during volatility spikes, liquidity imbalances, auction rotations, after hours adjustments, or rapid ETF inflows and outflows. But those deviations are extremely small compared to bond ETFs or international ETFs, because all S&P 500 components are US listed, high liquidity, and continuously priced. During fast volatility spikes, SPY may briefly diverge from SPX. Spread widening, depth removal, sudden order flow shocks, and elevated implied volatility can push SPY a little off its fair value. But arbitrage compresses the difference almost immediately. You'll see SPY dip slightly below SPX's implied index level, and then realign within seconds. SPX options are cash settled, European style. They have no early assignment risk, carry large notional exposure, and are widely used by institutions for macro level hedging. SPY options are physically settled, American style, and can be exercised early, work well for retail level hedging, and follow standard equity option tax treatment. If you want to avoid early assignment risk, you use SPX. If you want small sizing and precise position control, you use SPY. SPY is optimal when you need intraday precision, tight spreads, smaller position sizing, liquid option chains. For most portfolios under roughly 6 figures, SPY provides the right balance of flexibility and control. SPX is optimal when you need cash settlement, no early exercise risk, high notional exposure, portfolio hedging at institutional scale, macro hedging. SPX is designed for large accounts, derivative desks, and volatility focused strategies. Scenario 1, $50,000 portfolio. You want to hedge a potential 2 to 3% drop during a CPI week. SPX options are too large for this account size. SPY options are the correct tool, granular, flexible, and appropriately sized. Scenario 2, an $800,000 portfolio. You want a clean hedge with no shares delivered. With SPY, you might need dozens of contracts to match the exposure. With SPX, 1 or 2 contracts hedge the entire exposure. Scenario 3, tactical hedge during FOMC volatility. SPX options provide clean execution because of deeper institutional liquidity and a tighter implied volatility structure. SPY options will show more slippage and wider spreads under the same conditions. Because SPY holds the actual underlying stocks, its price action reflects sector level liquidity in real time. If the tech sector experiences a liquidity vacuum intraday, SPY will show exaggerated wicks and noise even when SPX prints a clean, smooth structure. Corporate actions create another important difference. Splits, spin offs, and index rebalancing events update instantly inside SPX because it's a calculation. SPY must adjust its actual holdings when those changes become effective through basket trades, portfolio rebalancing, and creation redemption flows. SPX implied volatility is smoother because it reflects the index as a whole. SPY implied volatility is more active because it absorbs ETF specific dynamics, ETF liquidity, gamma positioning, and intraday creation flows. These differences directly influence how options on SPX and SPY are priced. Drawing levels on SPX but executing SPY stops at SPY's volatility. Assuming SPY underperforms SPX without accounting for dividends. Using SPX options when SPY fits the account size more appropriately. Hedging small portfolios with large notional SPX contracts. Expecting SPY to print clean structure the way SPX does intraday. Confusing absolute price with percentage exposure. Ignoring ETF flow mechanics and the creation redemption process.